Okay, good morning, guys. Let's get ready for the day. And lots happening. Some pretty interesting economic data both this morning and this afternoon. Actually, we have earnings season sort of properly getting underway as well, with some of the big banks, JP Morgan and Wells Fargo, reporting earnings. Johnson & Johnson, we've got data this morning. UK CPI, we've got German ZEW. This afternoon, some top tier US data in the form of retail sales. We've got the ongoing Greek situation, of course, obviously, to be thinking about. And so let's just have a little review of yesterday, which was a pretty interesting reaction, and looking at the reaction in different asset classes, you got very different reactions. So, I mean, equities first, of course, definitely delivered a positive session. Not that big upside for Europe. I mean, if we just had a look at the DAX here, I know we've moved, this is a daily chart, and I know we moved up through the downward trend channel, which is important. But, in the end, the DAX was up, about just less than 1%. Now, Thursday last week, the DAX was up 2.2%. Friday last week, the DAX was up almost 4%. So big moves into the end of last week in anticipation of the political engine in Europe, finally reaching an agreement. And then this added a touch more to the upside yesterday. Really, a lot of that move came on the 7:40 a.m. news that after a 17-hour meeting, of course, the politicians had agreed in principle on a deal. I think as the dust settles, and the dust is settling now, you've got a few things to think about. Firstly, right in front of us, it's the political risk, firstly in Greece. This is not a small risk. This is where, of course, Tsipras has to now convince his government as well as opposition parties to vote through the set of reforms that Germany have forced on Greece. So they have to, of course, vote this through by Wednesday. This is some pretty phenomenal reforms on pensions, VAT, privatizations of state-owned assets. It is a package of reforms that is definitely worse, harsher than the packet of reforms that the nation voted no to in the referendum. And so politically this is going to be a bit of a minefield. Tsipras will not be able to rely on his own government to get a majority vote on this. And he has a majority of 12 at the moment. That's 12 MP majority. And it's almost certain that this vote will split the Syriza party, will also knock out the junior member of the coalition. He's going to have to rely on the more mainstream sort of opposition parties like the New Democracy Party in order to get this vote through. But then, so it's most likely they're going to vote yes tomorrow. But then the risk is actually, well, what happens to the Greek government? And, does Tsipras, with these MPs defecting, will result in him not having a majority? So two options: either he governs a minority government, a minority coalition, or he heads up a national unity government, which is like an emergency government where all parties are at the table. We had one of these back in 2012 when Papademos headed up a sort of technocratic government to negotiate through the second bailout. Tsipras has actually said, though, he is not willing to head up a national unity government. So even if the most likely scenario is Greece vote this through on Wednesday, but actually this doesn't really bring to an end this saga by any means, and I think that all we're doing is delaying the inevitable, and that Greece's government will fail. I think we will have another election in Greece, probably, some point further down the line in maybe quarter four. And the problem is that all these reforms, it's fine. Well, look, we'll vote them through Parliament, and honest, we will do these. But history tells us they won't, for whatever reason, whether there's just really not an appetite to do it. And I mean, really, Tsipras doesn't have a political mandate to actually drive through these reforms. So whether there's going to be reform fatigue, there always has been in the last 5 years, so there's almost certainly going to be this time round. What makes this time round any different? So I think that it looks like they'll patch together a botched job, and Greece will avoid default. Remember, if they vote through these reforms on Wednesday, they'll get bridging financing. Only if Germany vote it through their parliament on Friday, by the way. There'll then be a bridging loan over the summer to take care of some of these big bills they've got to pay, like the ECB $3.5 billion bill that's due Monday. So they'll get bridging finance, and then over the next couple of months, they'll negotiate a more long-term 3-year package, 85 billion from the ESM. That deal will include a restructuring of debt, which is going to see maturities just pushed way out. There'll be options where they can have interest payment holidays, kind of linked to GDP growth. The other side of it is the privatisation scheme, where they've got to raise 50 bill by flogging state-owned assets, and this money's going to go into a fund that's not going to be controlled by Greece. It's going to be controlled by Europe, and these funds are going to be used in different ways. So for example, of the 50 billion, if they raise it, and by the way, Greece have been sort of promising to privatise certain state-owned assets for 5 years and really haven't privatised anything. A lot of that isn't necessarily, some of it's the lack of appetite to do it, and some of it is just the inability to get a good price for any of these assets. People know it's a fire sale, so they're looking for a bargain. And Greece aren't necessarily happy to flog these assets at very depressed prices. But should they manage to somehow reach this 50 billion euro target, which I think there is basically zero chance, but let's say they did, 12.5 billion of that will be used to pay back the ESM funds used for bank recapitalisation. 12.5 billion will be used for growth initiatives, so that's a good thing. But then 25 billion will be for debt repayments. So of the 50 billion raised, not that they'll raise that amount, but if they did, only 12.5 billion of it would actually be used for growth initiatives. The rest is going straight out the door to pay back creditors. So this is the situation. Really, we've got the same old stuff. Another third Greek bailout, probably, and economically for Greece, I am not optimistic. And I think that the damage created by this uncertainty, this capital controls phase, the damage done to the economy in quarter two will be extreme. And I think it's set Greece back a long way. And I think that the political moves made by Germany here are not a positive thing for the idea that is the Eurozone project. And I think that we've got a deal, and markets are okay with that. I mean, positive moves yesterday, of course, on European stocks, but actually no one's a winner here. Greece definitely isn't a winner. Europe's not a winner. I think it's a bit depressing. So I think if we just think about what's going to happen from now on European equities, I think it's a difficult call, because on the one hand you've got a deal. Greece perhaps most likely will avoid a default, and so that removes a risk. The near term risk has gone, but I think the kind of medium term and the long term risks remain. I think Greece will still default. It's just delaying that again. I think that the Eurozone is now worse off. I think political relationships in the Eurozone have been severely damaged, and this is a political project, remember, the Eurozone, and if the political relationship is permanently scarred, which I think it probably is, then ultimately it doesn't bode well for this project as a whole. The idea that we need to move towards a more fiscal union to make this project work, well, the chances of that have been severely damaged. So I think long-term prospects are questionable for the Eurozone, and I think the Greek economy is going to get severely damaged, perhaps not as damaged as it would have done from a default, but I think that damage will be ongoing and prolonged as it has been for the last 5 years. So what's happening this morning is you're getting a little bit of a hangover from that mild relief move yesterday, and so stocks are drifting back lower. If I was to show you, let's say, let me get my Euro stocks chart up here and looking on a 1 hour time frame, then this morning we briefly went up to have a look and test yesterday's high, but we kind of trapped back low. These markets are marginally down on the day. We're in a bit of a tight range. I'm a little bit on the fence here on European stocks. I think we've had a big move higher. If you consider where we were middle of last week, Euro stocks bottomed out last week, 3,280. This is 300 points to the good. That is not a small amount. When you're thinking about that in percentage terms, it's quite remarkable. We're basically 10% off last week's low. Now, sure, that's fine and fair enough because we've perhaps avoided the Greek default scenario, but the question is, can European stocks rally more from this point? And I think initially the answer to that may well be no. But then is there an argument to say this rebound is not justified? And the answer to that's probably no as well, because we've avoided default. So I'm a little bit on the fence here on European stocks now. Unfortunately, I don't get a clear sense for direction, especially with these political risks that are still ahead of us this week. So I think we're going to get a day of reflection, and maybe it'll be a day where finally we can switch our attention away from Greece and think about some other stuff. And some of these economic data releases that we've got coming up are important. So I'll talk about those in a minute. Just quickly looking around the other markets, the S&P had a good session yesterday. Nice bullish move, 1.2% to the upside, breaking up through the gap that was created by the sort of Greek risk when Tsipras announced his referendum. So the weekend of the 27th and 28th of June created a gap. We smashed through that yesterday and we're right up at the top side of that now, consolidating the move. But this puts us mid-range. So, one of the elements of yesterday was that if the Greek default risk is removed, which it pretty much is, not quite fully, but it's not far off removed, then perhaps we should turn our attention to the Fed. And what we're going to see tomorrow is a very important speech by Janet Yellen. So she's got her semi-annual testimony. So that's going to be key. We don't have a Fed meeting for another 2 weeks, and this will be the last Fed meeting before the September meeting, which has been earmarked as a potential date for the first rate hike. So, this speech this week and obviously the meeting in 2 weeks' time are phenomenally important when it comes to considering whether the Fed are going to make a move in September. And because Greece are going to probably avoid default, it increases the likelihood that we'll get a September hike. I don't think it'll happen. I'm definitely still sticking to my guns on a no hike before December, but I think market expectation has slightly changed. So S&P moved higher yesterday, but consolidating that move. We've got earnings today as well, so we'll switch attention to that. Also retail sales, so this is going to be important and certainly drive movement in US stocks. But if we just look at the euro dollar, this is one of the big, well, not surprise. I was saying yesterday morning, it's really hard to see how the euro dollar can move up. I said that even if there's a default or no default, the euro dollar is probably going to move down. I said that in a default scenario, well, that's bad news economically, and you're probably going to get more ECB QE. That's negative for the euro. Okay, that will mean the Fed will hold off on raising rates, so that's negative for the dollar, but the euro negativity would override that, and the euro dollar would move lower. What we saw yesterday was the opposite, was the other scenario. So Greece avoiding default. Well, here as I've just described, is perhaps not particularly economically positive for Europe, this outcome. And all it does mean is maybe there's an increased chance the Fed are going to hike in September, so you get dollar strength, and that's what happened. Big move yesterday. After an initial upside, if you look on the daily chart, the move yesterday was 1.2% down off Greece avoiding a default. The euro drops 1.2%. And actually, if you take it off the high, it was even more than that, over a 1.5% move. That's a big move for this currency pair. So we're testing the 110 handle. And, we'll see. We've got key data this morning and then US data this afternoon, and this will be, that retail sales figure this afternoon is certainly going to be important in that consideration as to when the Fed are going to hike. But I would be bearish on euro dollar over the next few weeks as we switch our attention to the Fed. People reflect more on this Greek deal and just realise that it's nothing to be pleased or excited about. The Bund was another big, unusual mover yesterday with firstly big downside, then a 100% retracement, and this morning we've broken up above that. So the Bund initially risk on, so safe haven markets suffering as cash moved into risk, and then you had the reversal. And I don't know, I mean, this is basically a market that's saying this Greek deal's not, as I've just mentioned, isn't particularly anything to get excited about. And the fact that we've sold off so dramatically over the last, if I go quickly to a daily chart, we've had such a big move lower anyway on the Bund over the last few months. And, again, we flirted almost with the 1% yield handle yesterday. And I think ultimately Bund's above 1% on a yield basis isn't really justified at this point. I don't think the economic conditions in Europe warrant that, and inflation situation has just tailed off slightly. We got German figures on inflation this morning that were in line, and so a pretty interesting reaction from the Bund yesterday, which was not mirrored in the US, with US T-notes selling off. But it rebounded slightly, but actually into the close last night, we almost made it back to the low of the day. So this is T-notes reacting to the risk-on move, plus then also being influenced by the fact that this Greek solution means there's a higher likelihood the Fed will hike in September. So you had a real detachment from T-note and Bund correlation yesterday. Oil's another important one. Again, this has gone kind of under the carpet a little bit. This move over the last few days has been important. Well, you can't see it on this chart. If I go to a daily chart, this is a big move over the last week or so. Having been tracking on $60 for 2 months straight, an important break lower. This is helped along by the fact that the Saudis are continuing to subtly hike production. We got 10.2 million barrels a day. It's a little bit uncertain, but it looks like Saudis are, I thought it was at 10.4 actually, but the Saudis are marginally increasing production. You've got the shale industry also actually slightly increased production last week, and then you've got the Iran deal, which is perhaps maybe the biggest catalyst here just over the last few days. And overnight we have seen finally a deal has been done. Okay, so this is the kind of big news from overnight. Iran agrees a landmark deal. Why is this negative for the price of oil? Because this would unlock Iran have been under sanctions for a decade, and in recent years these sanctions were ramped up over the last sort of 3 years because of the nuclear risk, and this means a lot of Iranian crude supply is not available for delivery, and a deal between the US and Iran frees up this supply, and so you get more deliverable supply, which has just knocked this price of oil out of its trading range at $60 and back down and nearly down to 50. And if I just quickly go back to the 1 hour chart, a couple of important levels. This morning's low is the low that we had back on the 8th of July, and then the important level is $50.58. This was the low point of the month. and a break of that would almost certainly set up a test of $50. This morning we've been quite neat, breaking below yesterday's low, trading down to the 8th of July low, rebounding back to yesterday's low, which is also S1, resistance there, and now we're kind of just consolidating. So quite neat technically here this morning. So crude remains under pressure, and key Iranian news overnight. So that's a little bit of a look around the markets. Let's have a look at what's on the agenda. Let me bring up the calendar. So we've already had that German inflation data that came in line, so plus 0.3% month on month. These are final readings for June, minus 1.1% on, I presume that's year on year. They made a mistake here on the table. But let's look at what we've got coming up. So at 9 o'clock we've got some Italian data, but really the next big figures are out of the UK. So we've got UK inflation, house prices as well, but most eyes will be on the UK CPI reading, which is expected to be 0. Let me just show you the chart here. Of course, so 0 would mean a slight tick lower. This is annualized CPI, and as you can see, this will make 5 months in a row now of net zeros. Remember, this is the record ever low for UK inflation since they've been measuring CPI going back to the start of the 70s. Record ever low, stays on a record ever low. Of course, a lot of this is due to the price of oil. Maybe it's more important, and really it is more important, to be thinking about core CPI, where we're expecting that to remain at 0.9%. Okay, so that strips out food and energy. So if I just go back and bring up the core CPI chart, 0.9% is still well in line with the month, the data we've already had for June. So just confirming that 0.9 reading, and it'll be a second month in a row below 1%. So if you're thinking about rate hikes from the Bank of England and how will the timing of the Bank of England hike compare with the US rate hike, well, as it stands on a core CPI measure, the UK is way behind. The US core inflation number is at 1.7%, much closer to the 2% target. So on a core inflation basis, the Fed are definitely going to move first. And at the moment, I would say my estimation would be Fed moves at the end of the year, Bank of England moves next summer. That's current expectation. Back to the data calendar. After 9:30, German ZEW data. Now, this is important. We've got two components for this: current situation and expectations. Okay, the expectations component is more important. We're expecting 28. Here's the chart, and so this is a measure of the level of optimism of basically analysts, economic analysts. The expectations reading, the most important component, is how optimistic are they about the next 6 months. The current situation component, the least important, is how optimistic are they about conditions right now. So 28 is expected, which means a continuation of the drop-off from the highs we had back through end of quarter one, start of quarter two. Okay. Of course, the Greek situation is largely to blame for perhaps this decline here. We're expecting that decline to continue. Okay, a reading above 31.5 would be important because it would mean an improvement on the month before, when we're expecting a continued decline. All right, so we'll see what that data brings. That's at 10 o'clock. I'd say that's the most important data of the morning. Back to the calendar. We also have industrial production out of Europe at the same time. We're expecting plus 0.2% on the month. Okay. Then let's just scroll down to this afternoon. Lots of stuff on here, but really the only thing to be interested in is retail sales from the US, due at 1:30, and the headline figure is expecting to show a reading of plus 0.3%. When you take out automotives, then we're looking at a plus 0.5% reading. So we're expecting positive numbers here on retail sales. Quick look at the chart. This is the monthly readings over the last sort of 12 months, and after a real soft patch in quarter one, we've had some pretty decent numbers over the last 3 months, particularly the two readings, 1.5% and 1.2%. So we're looking for a fourth reading in a row positive, which hasn't happened, as you can see, for 12 months. So it'll be important that we get another positive reading, and if the ex-autos number is strong like we're expecting, then this shows consumption's picking up, and this is going to be on the Fed's radar when they're thinking about pulling the trigger on rate hikes. So this is an important number at 130. Other than that, less important data. NFIB, small business optimism number at 2, business inventories at 3. These are definitely not important when you put them alongside the retail sales data. That's the big number of the day. Okay, just scrolling down. That's it on the calendar in terms of economic data. Now we also have, I'll talk more about the earnings season a bit later, but we've got earnings reports. It's really going to start to pick up. The season began last week, but really it starts to pick up today with some of the big guns coming in. So the 2 big banks, JP Morgan and Wells Fargo, also big healthcare stock, Johnson & Johnson. And so this really gets the ball rolling on what will be a busy couple of weeks ahead when all the big companies report earnings. I think we've had 22 companies report so far. 17 of them, so 17 of the 22 S&P 500 companies that have already reported earnings, 17 complained that the strong dollar has hurt their performance. So get used to more of the same, and the dollar having a negative effect on US exporters. But we'll talk more about the earnings season later. But for now, let's see what we get. We've got data out of the UK in 25 minutes. And maybe I'll just quickly finish by looking at cable, actually. So here's the cable chart, and this has been quite weak over the last sort of month. If you're tracking from mid-June, then we've had a big move to the downside, but it's now rebounded just over the last few days. And so end of last week we had a strong bounce, but that's just been given back into the close last night, and we're trading a little bit lower. I just quickly go to the 1 hour chart. Then sterling, sorry, this chart needs a bit of updating in terms of the levels, so perhaps ignore the exact positioning of some of these lines. Just quickly tidy it up, but I think going in, we've got inflation data in 25 minutes, and sterling's just on the back foot. So you perhaps have got a little bit of nervousness here about the inflation reading that's about to hit the wires. Remember, expecting 0 on annualized CPI, and of course there's always the risk we might dip into negative territory again, as we were 2 months ago. So we'll see how this comes in, but certainly all eyes on cable at 9:30 as sterling reacts to inflation. Switch then to European markets as the ZEW hits the wires at 10 o'clock, and then we'll think more about the US when we get retail sales at 1:30. All right, should be an interesting day. Thanks.